Do you remember the three statistics we talked about last week? That 90% of all businesses fail within 10 years, that the life cycle of an economic cycle in our country on average is 10 years, and that 90% of all business owners don't read or don't know how to read their financial statements. We say that all three of those random statistics are connected. Hello, my name's Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Self-Storage Quick Start Academy. And I support the small investor who wants to get in or grow their self-storage business, do so in a strategic manner that creates true wealth and a fulfilling career. And last week we talked about the fact that most business owners have very limited financial knowledge. I have very limited financial knowledge. But look, if you're in the game of self-storage, you're in the game of business. And if you're in business, it's critical that we develop enough financial knowledge to be able to at least read the financial statements. We call those the scorecards for our business. Now we're going to assume that the three statistics we talked about are related, and we're going to do what's necessary in order to be the 10% that knows how to read the financial statements, that lives past the life cycle of an economic cycle and survives more than 10 years. And we're going to do that through self-storage. And we talked about last week the three scorecards that are used to score how well you're doing in the game business. And we talked about the first financial scorecard, scorecard number one. The accountants, or who I call the scorekeepers in the game of business, they call that the balance sheet. I call that scorecard number one. If you did not watch last week's or read last week's episode, my request is stop now, do that. That was episode 116. Then this episode will be in context. So if you remember, scorecard number one is what the scorekeepers call a balance sheet. It measures what I call the things and stuff of a business. They call it assets. It measures what we owe in our business. They call that liabilities. And it measures what we own in our business. And we own mostly our profits. And there's two kinds of profits. There is profits that were made over a certain time period that the scorecard we're going to talk about today creates. That goes on scorecard number one. And also any profits that the company has made since the beginning of time, since it was born, that they haven't given back to the owners that are still left in the company, those are on that first scorecard, and that's called retained earnings. I just call it profits we haven't distributed to the owners. Now there's a lot more to that scorecard. Some we'll talk about in this and future episodes, and some I'll never talk about because I don't find it that interesting and I probably don't know that much about it. But the scorecard number one is like a snapshot. It is a picture of a company, number-wise, in a moment in time. And now we're going to talk about scorecard number two. Now, scorecard number two is the card that all business owners love to look at. I love to look at it. It's the scorecard that seems to make sense to us. And it looks like this. So this is scorecard number two. Now, for years, I would look at this scorecard and think, I know what's going on. Well, turns out I didn't. Income's easy to understand, right? That's how much sales, how much rent, how much money you make, right? Well, kind of. In self-storage it mostly is, because mostly what goes on scorecard number two is money that we put into the bank, and money we made from selling stuff, and money we made from renting trucks, and expenses. Expenses are what it costs to run the self-storage facility, right? Well, yeah, kind of. And you look at the scorecard, and if the number down there is positive and big, we celebrate. If the number at the bottom of scorecard number two is a negative number, we get upset. Now, as a business owner, most of us have our self-worth to some degree tied up in those bottom numbers. Now that's another episode and another subject. It took me a while to realize that that is the wrong place. If you're going to have your self-worth tied up in some numbers, that is the wrong number to have your self-worth tied up into. Now I'm going to say something many people might not agree with, but scorecard number 2 is a theory. It is not a fact, it is a theory. It is the theory of how much profits your facility or a company made over a given period of time. Now, don't get me wrong, I'm not minimizing it. It's an important theory, but it really is only a theory. It's not a fact, and it has nothing to do with how much money you have or how much money you've made. Something to do with it, perhaps, a little bit, but not really. It is a theory. So if you look at a monthly P&L, and we were showing $50,000 in income, and you had $20,000 in expenses that month, then you had $30,000 profit, right? So you made $30,000. Easy to understand. But think about that a minute. You made profits of $30,000. You can't spend profits. Now, you can spend cash, you can spend money, but you can't spend profits. Now, go look in your bank. Do you have $30,000 in your bank from that month or that time period? Probably not. You probably don't have $30,000. Go check. Look at last month's scorecard number 2. The scorekeepers call it profit and loss or an income statement. Go look at the number on the bottom and see if you put that much money in the bank. Here's what I know, 99 times out of 100 you didn't. Have you ever had a great month and not had enough money to pay your bills? Have you ever had a good year on paper, but when it came time to pay the taxes, there was no money there? Well, the reason is because scorecard number 2 is a theory. It's the theory of how much profit your company made. Profit and money are two different things. You can't spend profit. Try to pay your light bill with profit. I don't have any money in my bank account, but I have some good profits on my profit and loss statement. Take that. No one will take that. People take cash. People take money. They don't take profits. So you see, it turns out that some of your income did not come in the form of cash in most cases. Now, most of us use what's called accrual accounting. I don't want to get too much into detail, but the moment a bill is due, the rent is due, on accrual accounting, it shows up as income. And on expenses, when you get the bill and it goes in that month, that's when it shows up as expenses. You may have $20,000 of expenses, but only have enough cash to pay for $10,000 of it. But yet on your profit and loss statement, all of that $20,000 is expenses in that month. And the reason is, you want to see how well your facility's running. Typically, we put 1/12 of our tax bill every month in the expense column. Sometimes in some facilities, we literally pull that money out of one account and put it in another. But most of the time it just shows up as an expense and we pay that bill once a year. Yes, income and expenses are tracking transactions, and you could get cash for a transaction or you could get an IOU for a transaction. You could give cash for an expense or give an IOU, like a credit card or like we'll pay it next month. So what shows up on the profit and loss is the theory of the amount of profits your company made. Now again, it's an important theory and it tells us some stuff. So if you've got a scorecard number 2 that consistently month after month has a negative number at the bottom, that tells us that your business model is probably not working. That does not tell us how much cash that your company's creating. And that's where the third scorecard comes into play. The third scorecard, or the card I call scorecard number 3, the accountants call it the cash flow statement. Now what is so weird is I have never had an accountant give me that report. I've always had to go find that report. They can look at the scorecard number 1 and scorecard number 2 and perhaps deduce how much cash is left from the profits on scorecard number 2. But I can't, can you? Now we're going to talk about scorecard number 3 next week, and we're going to tie them all together. But what there is to know is, and what I messed up for decades, was looking at scorecard number 2 thinking I was understanding it. Now, there are some cool things about scorecard number 2. So you remember scorecard number 1? Remember what you own? What do you own? You own your profits. The accountants say that we own our profits. We also own the amount of money that we put in to start the company, or investors put in to start the company. The investment money, we own that. And we own our profits. So on scorecard number 2, what you see at the bottom of scorecard number 2, look where else you'll see that number. You'll see that number, yes, on scorecard number 1, right here, under own. Remember, you own your profits. I think that's cool. I'm beginning to understand something. I see a number coming from scorecard number 2 going on to scorecard number 1. Remember I said scorecard number 1 is like a snapshot? Well, scorecard number 2 is more like a movie. It's like what happens over a period of time, over the month of March, over the year 2015. It measures a period of time, and whatever the theory of profit is on scorecard number 2, when they take the snapshot of scorecard number 1, that's the profit that was made, and that's what goes up onto the scorecard called the balance sheet. And it goes under the line profits, net revenue. They call it different things. It's weird. Accountants have many names for the same thing. So if you look at scorecard number 1 and see the theory of profits, you can look at scorecard number 2 and see the theory of how that profit was made. They're beginning to tell a story. Scorecard number 2 details the story of how that number got on scorecard number 1. And if you want to see more of the story of some of the other, let's say you want to see the story of the retained earnings or all of the profit that's ever been made, what you do is you create a scorecard number 2 that is a movie of the company since the beginning of its inception, or for the past 10 years. You can create scorecard number 2 to look at a period of time. Any period of time. Could be a day, a month, a week, a year, a decade. Doesn't matter. But remember, you can't spend profits, can you? You can spend cash. So it seems to me like there's something missing for most of us. And what's missing is the report called the cash flow statement that talks about the cash that's generated during time period in scorecard number 2 and explains the numbers of the cash that shows up on scorecard number 1. Now again, I find it strange no scorekeepers ever handed me that. I had to find out on my own about that. And we'll talk about it next week. But you're beginning to see now, using the scorecards that scorekeepers use in business, you can begin to see that kind of the job of the business owner, your job as a storage owner, is to buy assets or build assets, then turn those assets into sales, and then have those sales translate into profit, and then turn that profit into cash. And not just any kind of cash. You see, it turns out there's 3 kinds of cash. So, according to the scorekeepers, there's investment cash, there's financing cash, and there's operating cash. And in the game of business, not all cash is created equal. Which cash do you think is better? Yeah, that's right, operating cash. So in many ways, one of the ways you can measure the success of a business owner is how well they turn profits into operating cash. I never will forget the first year I was in business for myself. I made triple the amount of money I'd ever made working for somebody. And then the tax bill came around and I owed 10 times more than I'd ever owed before on taxes, and I had no cash to pay it. And I was shocked. How could that be? Well, I was not very good at turning profits into operating cash at that time of my life. So as a business owner, your job is to turn profits into operating cash. We're going to talk about that very specifically next week. But remember, the game is not how much profit you're making, which is what I thought the game was for years. The game is how much operating cash do you have? Because your operating cash is what you can distribute, it's what you can pay. And we'll talk in detail next week about the different types of cash and some of the funny games people play with the different types of cash. Now the beauty is you're in self-storage and nothing can generate operating cash as efficiently as a self-storage facility. So remember the 3 statistics. 90% of all businesses fail within 10 years. From the bottom to the top and to the bottom again of an economic life cycle is about 10 years. And 90% of all business owners don't know how to read a financial statement or don't read a financial statement. I say those 3 are tied together, and we're creating ourselves as the 10% that does last past an economic life cycle, that does last past 10 years, and we do know how to read the statements and take the information from the statements and generate new, specific, targeted action that will affect the numbers that we're looking at on the statement. And next week, we will tie all 3 scorecards together, and we will use self-storage to create true wealth and a fulfilling career. And we will know how to read our financial statements to guide us to achieve that outcome. My name is Mark Helm, and I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Storage World Analyzer. I love that program. I'm in that program every single day, analyzing self-storage, and it is the fastest, best way to analyze storage opportunities, no matter what they are, whether they're build from ground up, expansions, conversions, it doesn't matter. That program will analyze them very quickly and effectively. It is by far the most powerful tool that we use to grow our self-storage business. If you want to find out more about it, you can go to creatingwealththroughselfstorage.com, look at Storage World Analyzer, or go to storageworldanalyzer.com. Find out more about it if you want to get in and grow your self-storage business. So thank you. I look forward to being with you next week. And go out this week and take scorecard number 2 and look at it and try to see how much actual cash you had at the end of the month compared to the theory of profits that scorecard number 2 is reporting. I'll see you next week.